Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Amanda Lynam of BlackRock saying uncertainty around the path for monetary policy in 2025 is elevated. While not our current base case, a re-acceleration of inflationary pressures materialising from potential fiscal and or trade-related policies following the US election could cause the Fed's terminal rate to land higher. Amanda joins us now for more. Amanda, good morning. It's good to see you.
Good morning. Thank you for having me.
It was only a few months ago we were talking about the Fed getting ahead of the curve to insulate the labour market, and maybe they needed to get accommodative. And now we're back to a word that you use in your work, which is normalising, except normal might be a whole lot closer to where we are than we thought a month ago.
Right, and I think that distinction between normalizing and easing is really important. We would not be surprised for the Fed funds terminal rate to land somewhere around 4. But again, the drivers of that are really important. If that is because growth is holding up really well, that is something that the credit market can really digest. If that is because inflation is reaccelerating and there's a lot yet to be seen on the policies that are coming down the pike, we have some clarity, but the path is very wide in terms of potential outcomes. That would be a much less supportive outcome for credit, especially if it's coupled with slower growth. I think the bigger risk for corporate credit is what we're characterizing as a disorderly sell-off in Treasury yields. If we have a gradual backup in Treasury yields, again, because of good growth, that is actually a tailwind for credit because it brings in yield-based buying. If it's disorderly, feels spooky, then it's coming back to the fall of 2023 when I think that would give investors some pause.
Can you define disorderly and how orderly things are at the moment?
When we chat with market participants, that 4.60 level is really the area at which they become concerned. I think if you start to see the velocity of that back up really be swift, so I'm talking about gaps of 15, 20 basis points in a day for a consecutive period of time, and again, not driven by positive growth surprises, but more driven by some downside risks on the policy side or upside risks on the inflation side. That's, I think, where we would start to be a bit concerned, because then if you're a yield-based investor, you may come to the conclusion that it just waits to deploy capital into corporate credit, and that yield-based demand has been incredibly strong. In the context of all of this kind of path dependency, as you know, credit spreads have made news cycle tights, and so that tug of war between spreads and yields is very much still in place.
John asked the key question, yes. Right? What constitutes a disorderly move in yields at a time where 15, 20 basis point moves are something we have seen? This isn't abnormal, and there's a question of whether they have to stick for a longer period of time. I mean, let's say Howard Lutnick gets chosen as Treasury Secretary, and people view this as really an endorsement of stronger tariffs at the outset before some of the other tax cuts or other pro-growth types of implementations. Do you foresee that type of disorderly move in Treasury yields?
That sequencing really does matter. I think leaving some of the candidates to the side, if you have a situation where you have upward pressure on inflation, and I think what really concerns us is not so much the targeted tariffs, but the across-the-board tariffs that could spike retaliation, because then you're moving from a discussion of the one-time price level argument that's been floated, which I'm not necessarily sure I agree with is not that disruptive to the market. But if you have kind of retaliatory tariffs back and forth, then you actually have pressures feeding on themselves on the inflationary front. And I think it becomes much less certain. We kind of take a step back and say, okay, well, where do we go from here? We like building in floating rate exposure to portfolios. We like financials because they would not be exposed to the same degree on tariffs because they're more of a services-based sector. We like domestic-facing companies, actually. So ironically and somewhat counterintuitively, that may bode better for high yield and leveraged loans because they tend to be more U.S.-focused as opposed to multinationals. And financials are really important. Financials are 33% of the IG index, and they're still trading wide to non-financials. And so if we think that they can tighten, that can actually pull index-level spreads even tighter than where they are now.
There's a larger question, and John and Anne-Marie were focusing on this last week, about at a certain point, if you see the companies out there as being in pretty good shape from the U.S. and continuing to be so, could you see spreads narrow to such a degree that even investment-grade companies trade within Treasury yields?
Yeah. So I think you had a conversation last week on this with Brian Weinstein, which I thought was great. Look, I think there is scope for spreads to move tighter. I do not see a world where en masse, triple B corporates are trading tight to the sovereign. But you do have some AA and a few AAA companies still left outstanding in the corporate credit sphere that are trading really close. I mean, the spreads to Treasuries are in the single digits for some of those bonds at the moment, depending on where they're priced to. I think the net here of everything is that corporate credit is in a pretty good place. It all boils down to growth. If we have a supportive growth backdrop, I would say manageable tariff risk, and then I would say the continuation of yield-based support plus some favorable technicals, that's a recipe where credit can stay in its current tight range or even move slightly tighter. I think waiting for a significant catalyst for spread widening in credit would really involve a combination of persistent upward pressure on inflation, a slowdown in growth, and again, that disorderly sell-off, which it does feel like the volatility of the bond market has been elevated relative to what we've been used to in past cycles. But I think it would really be that kind of 460 range where folks get concerned up to the 5% range that would catch our attention.
Amanda, just talking about this disorderly bond sell-off, I'm thinking about how disorderly this Treasury pick has come to be. And if you talk about the real impact of tariffs, what I'm hearing from sources that Peter Navarro is really in the mix, this trade skeptic at NEC, and Howard Lutnick, who's come on and talked about the fact that you should use tariffs, is more of a yes man to Donald Trump. The real tariff man would be someone like Robert Lighthizer, who already worked for him. What would a Lighthizer at Treasury, Peter Navarro at NEC, mean for this bond market?
Well, again, leaving the specific individuals aside, I think the issue that we have to come to grips with is what does this mean for kind of ongoing upward pressure on inflation? And really the worst case scenario for credit is kind of an across the board tariff that is also coupled with retaliatory tariffs that provides kind of upward pressure on inflation that corporates can't manage. Right, and I think that's the key, is that if corporates are feeling that they have significant cost input pressures that they are not able to manage through, then you get to this situation where right now corporates have just been hoarding labor and they haven't been laying off. If you get to a point where corporates need to use the layoff tool to protect their margins, that's where I think we really start to get concerned, because that's when you could have the weakness in the consumer extend beyond the lower income segment.
Is the fact that the transition when it comes to the top post for financial markets already seems chaotic and it is messy based off every phone call I had over the weekend, is that already a market negative?
I don't think so. I think what we're really bracing for is for this to play out over the next couple of months. I mean, even heading into the election, we were not expecting ultimate clarity once we knew the outcome of the White House, the Senate, and the House. We know that this is, I mean, you've been saying it, personnel is policy, right? So we've been watching for these appointments. I think we're expecting this to be a longer term trend. The Fed has even said as much, that they're not even reacting to policies once they're implemented. They're actually more poised to react to policies once you see the economic impact, which will take some time. So I think this is going to be a drawn-out event actually into 2025.
That said, I'm glad that you brought the Fed into this, because that's been the other big shift over the past week, is that some of the rhetoric out of Fed officials has been talking about how they can afford to wait. Yeah. They don't have to cut rates as quickly. How much is that a game changer on certain levels, that there isn't the same kind of dovish bias that there might have been, say, a couple weeks ago?
So I was a little surprised at the market reaction last week, because a lot of what Chair Powell said, he also said during the November 7th press conference in terms of we may slow the pace, we're not in a rush. I think our base case is really that there will be a cut in December, a 25 basis point cut in December. As you noted, though, at the start, the path becomes much more tricky into 2025. It all boils down, though, Lisa, to kind of what you're alluding to, which if they're not cutting because growth is above trend, which we still are tracking above trend, that is a backdrop that corporate credit and I think risk assets broadly can manage. If they are not cutting because they are concerned, to Anne-Marie's point, about upward pressure on inflation or disruptions in supply chains, that sort of thing that would cause inflationary pressures, that's another issue. But they are also focused on growth. I think it's not a foregone conclusion that tariffs could cause them to not cut or even hike, because there could be a growth impact that they are focused on as well.
We could see some major changes. Amanda, it's good to see you. Appreciate your time. Amanda Lynam there of BlackRock. Here's
Here's the latest this morning. The eyes of Wall Street on a battle royale playing out in Palm Beach, Florida. The race to become the next Treasury Secretary between Scott Bessent and Howard Lutnick reaching boiling point over the weekend. President-elect Donald Trump said to be losing patience with infighting, leaving staff to widen their search. Alternatives now including Apollo's Mark Rowan and former Fed Governor Kevin Warsh. Henrietta Treyz of Veda Partners joins us now for more. So Henrietta, the big question, where is this one going?
Well, I think the most important decision really is about what happens with Robert Lighthizer, as you guys have been mentioning. I think there's very limited amounts that the Treasury Secretary is going to do in terms of writing tax bill with Congress. This isn't the first time around where we're crafting it out of thin air. That tax bill is going to be written by the Senate Finance Committee staff, the Chairman Mike Crapo, and the House Ways and Means Committee and their staff. And the Treasury Secretary is going to be influential to the street. But in terms of these massive pieces of legislation, it's tariffs and taxes. And I'm really more concentrated on where Bob Lighthizer is going to go than whether it's Scott Bessent or somebody else at Treasury right now.
Well, Henrietta, according to my sources, Robert Lighthizer is still in the mix, as well as Senator Hagerty when it comes to Treasury. What would a Robert Lighthizer at the helm of Treasury mean?
You know, what I'm wondering is whether he's going to do something in the trade czar universe. That seems to be the main theme of the Trump cabinet pick so far, whether it's the government efficiency initiative, which has sort of an efficiency czar, crypto czar, or Bob Lighthizer in a role that's more like a trade czar. He doesn't even need to be at Treasury. I think it's pretty unlikely that he would land at Treasury. I think the president-elect is enjoying this process of having a big fight for the transition. We definitely saw this last time around as well, so I don't think it should come as a surprise. But sort of a roving czar that has authority over USTR, the Department of Commerce, and Treasury is going to be much more important, in my opinion, than Treasury Secretary itself.
When you read the tea leaves, though, and you see that potentially, and sources are telling me that the team is trying to maybe give this off-ramp to Howard Lutnick, offer him a fancy first world-class ambassadorship. Potentially, then that would lead the way for either Scott Bessent to come up and get the nod, or they're going to expand the search because this is just becoming a little bit too messy between these two men. How do you read the tea leaves right now? And do you think there's going to be a timeline when we can get this nod?
Yeah, I think the Trump transition folks and people that I've spoken to who are working with them, they're trying to get as many names as possible. Specifically, we know that they're trying to get CEOs, somebody that comes with quite a bit of stature to come and fill that role already. They have not been able to find that particular human yet. And so we're still in the realm of the Scott Bessent, Howard Lutnick's component. I think Bessent probably for the most part has been out on the street the most, meeting with, big bulge bracket banks and hedge funds, talking about a very sort of slow, phased-in 5% a month increase in tariff rates. Those are the kind of things that I think when the details come out will spook folks. When it comes to the transition, the president-elect has actually moved very quickly. I would expect the Treasury Secretary to be somebody that's confirmed within the first 2 weeks, let's say, in January. So they want to get somebody that's actually able to get through, not a Matt Gaetz-like candidate who's going to run into some serious ethical problems.
Right. When it comes to the Senate, obviously we think maybe the Treasury post could sail through. But you said the president-elect was moving quickly. Why is it taking him so long when it comes to Treasury? This is one area where he's not moving quickly, even though he ran on an economic agenda.
Right, and there's not just a clear loyalist that he's planning to place. Some of the others, whether it's a Tulsi Gabbard or an RFK Jr., were overtly on the campaign trail. In this situation, the folks that would have been in that role have already said that they do not want to take on the position. When you hear things like, going through the ethics component and the background check is preclusive, which I believe Scott Bessent said a couple weeks ago, it gives you an understanding of just how difficult it is to make the decision for these folks to go through the ringer with the FBI, with background checks, with the, disarming of their funds and really understanding where that needs to go. So I think there's a lot of personal decisions that go into Treasury in this role that are maybe a little bit higher bar than the Attorney General pick, for example.
Henrietta, how much do you see this as a test almost of how important the market response will be to Trump policies as sort of the ultimate check?
Well, I think the street is very heartened by the fact that they feel like they're playing a role in this. I mean, every single meeting I go to, investors think that the stock market, whether it's going up or down, has a real leash on the president. I don't think that that's true, just to put it bluntly, but it's definitely a view on the street that they have a say in what the Trump administration does and specifically how Donald Trump responds. So they're very optimistic, for example, in the bond markets that should his tax bill and tariffs go into effect in the same year. It's my expectation tariffs will go on in the first 4 or 5 months, and the tax bill be passed in December, July at the earliest. You're going to get these massive both inflationary and deficit finance pictures. And what I hear often is the bond market's going to send a message and stop that. That's just not the way that DC typically works. They are much more concentrated on, quarter over quarter GDP growth, unemployment rates. The president-elect has tweeted quite a bit about the stock market, but that's never led him to not impose tariffs, as we all remember from 2018 and 2019.
That said, Henrietta, we did hear from Mike Johnson, House Speaker, that there was going to be some sort of offset to any tax cuts. We heard from French Hill when he was on with us a couple of weeks ago that he's really going to be careful about not necessarily expanding the budget too much. Why do you think that ultimately that the market does not play the role that it thinks it does?
Well, first of all, it's not what Congress is watching. A tax bill is in existence for 4, 5, 6 years, 7 in the case of the last package. That's not, designed to boost the market on a day-over-day basis. President-elect Trump is going to be at the very beginning of his term, which is 4 years. Not every single day matters. It's just sort of a fundamental misunderstanding of how D.C. watches the U.S. economy and the stock market in general. And while I think President-elect Trump tweets about it, as I mentioned, it's very different than writing and crafting legislative policy that will increase the deficit by at least $2 trillion next year, whether the bond market responds or not. That's what it's going to take. That's what it costs. So when you talk about the government efficiency initiative, what I hear as a former budget staffer is really exactly the wish list that we get from an administration on the first Monday in February. You get the budget every year. It's very optimistic and wishful thinking. It includes a lot of offsets to offset the cost of the spending that you want to roll out, but ultimately very little of that actually gets effectuated. So when I hear the president and Elon Musk and Vivek Ramaswamy talk about government efficiency, what I hear is this is the thing that we'd like to do in a perfect world. It will not actually happen, but it's part of the conversation that's necessary to mitigate the appearance of deficit increases on the magnitude of $2 trillion, if not more, just to pass the existing tax rate.
We'll see. Henrietta, it's good to see you. Henrietta Treyz there, of Veda Partners. So here's the latest. Big retailers, including Target and Walmart, reporting earnings this week ahead of a shortened holiday shopping season. Kate McShane of Goldman Sachs writing Target customers are resilient, yet on a budget, while Walmart is well positioned to continue driving solid earnings. Kate joins us now for more. Kate, welcome to the programme. I want to talk about trade just to begin with. How battle-hardened are these companies from the trade war of a few years ago, and how well prepared are they for more of the same?
Yes, I think, frankly, the more discretionary goods you have and more that you're importing from Asia, the harder it is to manage. And so specifically to Target and Walmart, about a third of what Target sells is domestically sourced, so not subject to tariffs. And for Walmart, it's about 2/3 of what they source is domestically produced and not exposed to tariffs. So there is still quite a bit there in terms of exposure. The last time we did see tariffs happen, both Walmart and Target did take prices up. Frankly, most retailers did. And that's probably what will happen this go around as well.
Kate, I have to ask, especially ahead of Walmart coming out tomorrow with earnings, is Walmart still a retail company?
It's a good question. Yes, it absolutely is. But I think a lot of success that they have seen more recently has been with what they call their second P&L, or their alternative revenue streams, which is them building out a media business, a fulfillment business, their marketplace, data ventures. And they describe it as an ecosystem, all in which to better serve the customer with. But there certainly is a lot more tech and a lot more to understand from an e-commerce tech standpoint than there's ever been before.
The reason why I ask, Kate, is because we also get TJ Maxx and Target, and I wonder if those are really the cleaner reads on just consumer appetite, the consumer pushback with price increases, those kinds of consumer discretionary trends that people often look to in the likes of, previously anyway, Walmart.
Yes. Well, you still get the true read of what sales are doing in comp store sales trends, which they report every quarter. And we do get color from Target and Walmart about what sales are doing on the consumable side and what sales are doing on the discretionary side. And for all the success Walmart has had this year in terms of growing and taking share, their discretionary still remains somewhat flat. It has not been growing, similarly to Target's.
Kate, do you still see, and I know we talked about this when you joined us in September when this was really one of the storylines in the consumer sector, do you still see individuals on the higher income cohort trading down, this idea of being more choiceful?
We definitely see consumers still being choiceful, absolutely. The trade down hasn't necessarily happened to a degree. I think the story of the consumer is they're employed, and they do have cash. And the Goldman view is that the consumer will stay healthy into 2025 based on how strong the labor market is. I think where we're seeing a little bit of weakness might be at the lower income consumer, just as they continue to deal with higher prices. Prices are still higher than they were a few years ago. But at the mid and higher upper income levels, you are still seeing good demand. It's just, again, using that word choiceful.
Before we get to 2025, I have to get to the holiday season. And I just have to ask, why does Black Friday now feel like an entire week? It was supposed to be just one day.
Yes, it absolutely does feel longer. I would even argue it feels like the whole month of November has turned into Black Friday. And we are contending this year with 5 less shopping days. We have a Thanksgiving that is the latest point in the month that it can be, and there's 5 less shopping days as a result of that. So you're even seeing differences year over year in terms of when you're seeing Black Friday ads and Black Friday deals. But it's all in the name, of course, to engage customers.
Has there been any signs yet? Because I already see the Christmas trees up. I already see the wreaths. I already see, get your holiday deals. So it's basically 2 months, Black Friday, 2 months. I'm just wondering whether we have any early signs of what the appetite has been like for the holiday season.
We don't quite yet, and that's why I think earnings are so important this week for Target and Walmart, because they will have a read into the first couple of weeks of November, and hopefully they will comment there about how sales are going or how they are relative to what we saw in October. So we'll definitely get a better read on that when we speak with them this week. I think data has showed, traffic data at the retailers has showed some acceleration into the end of October, early November. So it does look like you're seeing growth in traffic, which is a good sign. But again, we'll get it straight from the company's mouths this week.
Tree went up this weekend.
I knew it would.
I knew that was aimed at me.
I was completely aimed at you.
I felt it. It felt personal too.
Yeah, it was personal.
Saturday afternoon.
Really?
Yeah.
Fully dressed or not yet?
Fully dressed.
You have a panettone as well?
Had a Pandoro, first one of the season.
Nice.
Yeah, ready to go.
I did. I walked by a Whole Foods and I saw all the trees outside, and I saw that the prices were the same this year as they were last year. I thought that was interesting, and I thought Jonathan Ferro right now is putting up his tree.
I'll spare you this conversation, Kate. Thanks for joining us this morning. We appreciate it. Kate McShane there of Goldman Sachs.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.